Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talks, where we want to offer you financial information and meet you where you are financially so that you're able to stick to your budget, manage to pay off your debt, and begin to save on your path to building wealth. Today, guys, I want to talk to you about what it means to really prepare yourself to apply for your mortgage loan. If this is your first time joining me here on the channel, go ahead and hit that subscribe button and you'll be notified every time I upload a new video. So one of the biggest purchases or decisions that you can make is applying for your mortgage loan. And in this time where many people are looking to purchase, buy a new home, and the market is having a shorter supply of homes, or you're considering refinancing, the process to prepare and the details that go in are very, very similar. So I thought this might be helpful and a great time for you to understand what you can do to give yourself some confidence as you go through this process. Number one, if you're applying for a mortgage loan right now, whether it's purchase or refinance, understand in the case of a purchase, likely there may be a little lag just in the timing because of the overall demand. So typically a purchase closes in about 30 days, but I would allow at least a couple days for that. And when you think about, hey, I'm about to purchase a home, don't, or a best practice would be, hey, can I go ahead and secure the loan, get the loan in process? Once I have an idea of that loan being in process and things are going forward and things of that nature, then set your sale date, then set up your moving, then set up all those different things. When you set up your movers and when you set up, hey, we're gonna close on this date, but you haven't even secured or started the process with the financing, and especially in a time like this when things are busy, that adds undue pressure to yourself and unfortunately to whatever company you decide to work with. Because the fact is, it isn't until you start going through that underwriting process and things of that nature where something could come up and delay that date. But you made a date and you're trying to force the hand of any organization. And the fact is, that may not happen. And you may either lose the deal or find yourself in a very high pressure scenario. So if you secure the financing or at least get as deep as you can in that process, then set your date, then set your movers and things of that nature. It helps make for an easy transition of a sale. Hopefully that's helpful, number one. Second, you want to think about, okay, what documents and what things do I need to be prepared for if I'm going to do a purchase? Well, when you fill out a mortgage application, typically there's not much information needed for a pre-qualification, meaning some people may have you submit a W-2, most recent W-2, but to be honest, because in a purchase transaction, you don't quite know where your home is, there's not a high pressure or disclosures that need to be sent to you. So knowing a general amount that you would like to spend, typically go ahead and get your pre-approval for higher. That way you can bring that amount down if you get into a strange situation where you may need to put that number up. So it's always easier to come down on your loan amount than go up. Second, understanding, hey, whatever rates are right now, likely you won't be locked in because, again, you don't have a house. But once you provide address or non-address, or once you provide an address, once you provide a date, your income, your social, all those things, well, by law, that company has to send you disclosure. So it's not the fact that they want to give pressure to you to make a decision and things of that nature. They're simply trying to comply with the rules. Because think about it, in 2008, there were a lot of people unaware of the homes and the terms under which they bought. So this rule was created to actually help the buyer beware and even though the numbers may be raw, even though the estimates may be off a little bit, the fact is the lender, the company, the mortgage company has to send you something to give you some indication of what you're getting yourself into. Next, when you're thinking about applying, really think about what's some of your goals. And that's where I want to transition the conversation to. If you're in the idea of refinancing or if you're in purchasing, yes, the rates are incredibly attractive. Meaning these are the lowest, quite possibly these are the lowest rates ever. And that also means that the rates undoubtedly will go up. So if you're in a purchase transaction, when you think about buying this home, really think about, hey, what are a little bit of your long-term goals? If you're just starting out, newly married, it's likely you may move from this house. So when you think about, hey, what loan am I going to take because I'm always going to have PMI or things of that nature, well, that can cut in. But if you're putting down a large down payment, then you want something that's going to give you flexibility. The other thing is you want to think about, hey, how can you really maximize this purchase so that you can mitigate some of your future costs when you go to buy another home? In a refinance scenario, well, how do you know if it's really a good time for you to refinance? Well, if you're personally going to move within a year, I'm not going to suggest that you refinance because even though the rates are low, you still have closing costs. And in both scenarios, you're going to have closing costs. But that can actually, moving in a year, that type of time frame, that short time frame like that, you likely won't recoup the costs unless the lender was paying all the costs and you didn't have to pay anything for closing. That's only the situation that I would say makes sense for you to refinance. The second thing is when you think about where you are right now in refinance, I would ask you to question some of your long-term goals. A lot of people I've had the conversation and been fortunate to have a conversation with several people where the opportunity does present itself where you could say, hey, I think I might want to hold on to this property and I think I might want to move out, which makes this particular home a great opportunity to be maybe a first rental. And why would that option come available, or why would that be a viable option? Well, number one, because it's your primary home, you're getting a primary interest rate. And if you're moving down to the twos or to the early threes on your interest rate as a primary mortgage, and you're thinking, oh, I'm going to keep this as an investment property, well, you're lowering the operating cost until you're able to pay off the home. That's a good decision. The second thing is because it's your primary home, again, you're getting primary interest rates, not investment interest rates. Investment interest rates they cost more and they're typically higher than the primary interest rate. So, and when I say primary investment, I'm talking about primary property, meaning that's where you stay, that's where you live right now, versus, hey, I'm just buying this strictly out as an investment property. It wouldn't be considered investment property until you actually moved out of the home. But by then, you're already locked in at a lower rate. Hope you're following me with that. I know it can get a lot of nuance. But the fact is, really think about, hey, could I actually hold on to this property and have another asset that's gaining value? And of course, with real estate, you get paid three ways: your value, the depreciation of your taxes and how it helps offset your taxes, and the rent. So when you understand that, even if you're not keeping that property for 30 years, over the next 5, 6, 7 years, that can become and help you unmask a bit of wealth, because the property will be growing in value, because most real estate tends to grow in value every 3 years, and you're getting rent on that, and likely your rent will go up because the cost of living every year goes up. And then also you're decreasing your tax bill. And you may not be making money per se, but when you decrease an expense, and especially a tax expense, that's making money or putting more money in your pocket. So it's something to consider. Well, why would I say that now? And that's what I mean, because many people have the opportunity based off their income and based off a very conservative amount of their income. It's what you typically would pay for a home anyway. So if you were looking at a $400,000 house already, and you're you have one house that may be already that you're in 150, 100, something of that nature, well, I would look at you and say, hey, if you were gonna pay $400,000 on real estate anyway, why not buy your new house or keep your new house down to around three? Keep the other one. You're still paying $400,000 in a house, but that a piece of your house is actually making money, meaning you have rent coming in, meaning that piece is being paid for itself, and you're really paying for a smaller house. One of the things that millionaires do, and if you look at the millionaire next door, the next millionaire next door, they bought conservatively when they bought their homes, meaning they knew they could afford more, but they bought conservatively to allow them more opportunity to invest either in another home, pay off the home that they had, or they were able to free up cash to invest in the stock market or in business or things of that nature. I know it does stink because you're saying, hey, 25% of my income, I could buy way more house. I get it. But just because you can do something doesn't mean you doesn't mean you ultimately should. And right now you have an opportunity, if you can pause for a second when you look at your refinance scenario and say, hey, maybe you have a car note. Maybe you have a couple other bills. But if you really look at your situation and say, hey, if I didn't have the car note and if I didn't have the credit card bills, well, that right there might be equivalent to what I'm paying in a mortgage payment. So if I'm able to pay two mortgage payments, one is actually making money because you're renting it out. So you're getting help with that. But when you look at this from an investment and business standpoint, you want to make sure you can cover it. But that creates an opportunity that, hey, I can start to really fast track my wealth building over the next 3, 4, 5 years. And if over a year you don't like it, or if in 2 or 3 years the value just goes gangbusters and you're like, hey, I just want to sell it, well, you have a lot more money to play with because you can sell it, take that home. And if you're single, the profit will allow you to be $250,000 tax-free from the home. If you're married, that means you can take up to $500,000 off that home. And you definitely want to consult your tax advisor of how to maximize that ticket. But it is a great deal. So you're not just looking at a refinance. You're looking at this is a gateway to your actual wealth building and your future. And it's not just $1,000 or $500 decision. We're talking about this could potentially be $200,000-$300,000 decision. And it's really important. Again, when I speak to people that I'm coaching, when I'm talking to people about investments or things of that nature, it's not that I'm trying to sway you one way or the other. I really want you to understand what is your opportunities that you have right now. What I don't want you to do is once you get to be 60, 61, 65, and you're looking back over the decisions you made in your life and you're looking at where you are right now, because we all reflect at some time. What I don't want you to do is look back and say, hey, I didn't know I could have had a little bit more wealth if I would have just went this direction. I want you to know your decisions in the moment, know all your opportunities, know how it plays out. Yes, renting is scary. Yes, it's a new adventure. And yes, it does have some risk. But there are a lot of ways to mitigate the risk. And again, there are ways to set yourself up so that at the end of the day, if you don't like the house and you don't like the rental scenario, you can sell it. So, and right now it's a hot market, so it likely will sell fast. So I want you to be encouraged about what you need to do when you're thinking about coming to the table of, hey, I want to go ahead and refinance my home or purchase. But really think a little bit more long term, because again, these low interest rates are gonna go up. So if you're planning to refinance and you've had thoughts about keeping your home and for the long term and you want to ride it out, that's great. Refinance. That is going to pay you dividends. It's an investment. Even if your home is your primary home and that's where you and your family are, it's still an investment. An investment is an object that you put money in that has the potential to make money. You put money into the house via the mortgage raises in value, the home raises in value, therefore it's an investment. The car, you put money into the car depreciates in value. That's not an investment. So I want you to understand what's your opportunity. If you didn't have the car payment, if you didn't have credit card bills, could you pay comfortably and live your life for these homes to get your wealth building started? And that's all we're talking about. We're not saying you're going to continue operating your life like this, but you have to start somewhere. And this is just another opportunity to do it. Again, I hope this information is helpful for you. If you like it, go ahead and give it a thumbs up. If you haven't already, please subscribe to the channel. I can't wait to see you guys in the next video.